So right now, if you just glance at the financial headlines, you'd probably think consumer credit is basically a ticking time bomb.
Oh, yeah, definitely. That's the prevailing narrative.
Right. I mean, defaults are creeping up. People's wallets feel super tight. Inflation is just this persistent shadow. The general consensus out there is that consumers are stretched to their absolute limits.
Right, but then you look behind closed doors at a firm and they're seeing something that completely defies that broader panic.
Which is exactly what we are exploring today. Welcome to the deep dive.
Glad to be here.
So, for today's mission, we're looking at an exclusive stack of notes, specifically the raw Q1 2026 earnings call Q&A from Affirm. Now, to a casual observer, an earnings call transcript just sounds like, dry financial jargon.
Highly technical, yeah.
Exactly. But for you listening, this is actually a masterclass. It reveals how a modern fintech giant is navigating consumer psychology. We're going to see how they're integrating cutting-edge AI without breaking things and, well, quietly taking over the physical wallet.
It really is fascinating.
So I have to ask, given all that macroeconomic noise out there, how is Affirm actually doing behind the scenes?
Well, contrary to the panic in the broader market, a firm is looking at their specific consumer base and seeing zero signs of credit deterioration.
Well.
Zero. No panic, no stretching to the breaking point. Despite the headlines, their internal data shows a completely, incredibly stable credit environment. In fact, the capital markets are basically obsessed with their business model right now.
Okay, so let's unpack that. The disconnect between the market panic
Yeah.
and Affirm's actual ledger, that really comes down to the architecture of their business model, right?
Exactly. It's about what they sell. A firm specializes in short duration, fast turnover assets.
Right.
Unlike a traditional bank that might, issue a 30-year mortgage or a 5-year auto loan, a firm is issuing short-term loans for very specific purchases.
So instead of your money being locked up for decades, it's like a 6-week loan for a couch or a new bicycle?
Precisely. The money cycles back into the system incredibly fast, and the capital markets just love that predictability. Because investors get their money back quickly and reliably, they're essentially clamoring to fund a firm's loans.
Which gives Affirm a ton of leverage.
Huge leverage. This intense demand leads to oversubscribed deals and shrinking spreads for a firm.
I was totally struck by the math on this in the notes. Their financial breakdown shows their funding costs actually dropped by an incredible 125 basis points year over year.
Which is massive.
Right. And for anyone listening who isn't steeped in bond markets, a basis point is 0.01%. So a 1.25% drop might not sound huge to someone just shopping for shoes, but borrowing billions of dollars is basically a firm's raw material.
Yeah, it's their inventory.
Right. So reducing the cost of your primary raw material by that much, I mean, that's a colossal competitive advantage.
It really is. It allows them to maintain profitability without having to squeeze the consumer to make up the difference. But, the real curveball in their financials, the one that actually requires a deep understanding of consumer psychology to interpret correctly, is their allowance for credit losses.
The cash reserves they set aside to cover bad loans.
Exactly. Their allowance is actually increased quarter over quarter.
Which sounds bad. I mean, if their credit environment is so perfectly healthy, why are they suddenly keeping more cash on hand for failures?
Right. Well, this is a prime example of how surface-level metrics can be highly misleading. During this specific quarter, which coincided with tax season, a massive wave of consumers got their tax refunds.
Okay.
And instead of going on a big spending spree, a huge portion of them used that cash liquidity to just be financially responsible. They paid off their Affirm loans early.
Okay, wait, let's unpack the mechanics of that math, because it's a little confusing at first glance.
Sure.
It's like if a school's average GPA suddenly drops, but only because all the A-plus students graduated a semester early.
Right. Oh, that's a perfect analogy. Yes.
Yep. So the remaining pool of students looks slightly riskier on paper because all the top performers left the equation. But it's actually a massive sign of systemic health.
You hit the nail on the head. The total active loan pool shrank because the most responsible borrowers cleared their debt early.
Right.
Mathematically, the remaining loans, the ones just maturing at the standard rate they make the overall expected delinquency rate look slightly higher against that new, smaller baseline.
Which forces the allowance percentage to tick up.
Exactly. But ultimately, it proves consumers have liquidity, they prioritize paying down their debt, and Affirm's Affirm's initial underwriting was highly accurate. So it's this incredibly positive credit signal wrapped in a really scary-looking metric.
That makes so much sense.
Yeah.
But, that shrinking loan pool means they have to process higher volumes of new loans just to continue growing.
Oh, yeah. Constantly.
Which raises a huge logistical question. How do you scale a product pipeline that fast without completely ballooning your payroll and your operational costs?
Well, the answer to that points straight to their engineering team, and specifically what they're doing with AI right now.
Right, the AI transition.
Yeah, we are seeing a structural shift in software development here. Affirm's engineers are heavily utilizing what they call agentic code, and we really need to differentiate this from, a standard autocomplete tool that just guesses the next line of text.
Like the predictive text on my smartphone when I'm texting.
Right, it is far beyond that. Agentic AI operates on a much, much higher level. An AI agent is given a complex, overarching goal, for example, build a module to verify this new type of state ID,
Okay.
and then the agent independently writes the code, runs its own tests, finds its own errors, debubs them, and then submits a fully functional piece of software for human review. It handles the entire life cycle.
That is wild. And the notes say that as a result, the engineering team is processing twice as many requests as they were before.
Double the output.
Yeah. But what really stands out to me is the sheer cost-to-benefit ratio. Implementing these AI tools across their entire engineering base is only costing them in the low single-digit millions per quarter.
Which is nothing at their scale.
Right. When you think about doubling the productivity of hundreds of highly paid software engineers, a few $1,000,000, it's essentially a rounding error. I mean, they even pushed out dozens of launchable features in a single 48-hour internal hackathon.
Yeah, a velocity they admitted was just completely unthinkable even 12 months ago. You are looking at pure operating leverage. Their development speed is accelerating drastically, but the fixed costs barely move.
Okay, I have to push back on this a little bit.
Sure.
Because the obvious Silicon Valley playbook, when your engineers get 10 times more productive, is to cut headcount. Fire half the staff to boost margins. If AI has all these superpowers and is doing so much of the heavy lifting, why is Affirm explicitly stating they have zero plans for AI-related layoffs? Why keep everyone?
Well, it really separates the companies that view AI merely as a cost-cutting measure from those that view it as a growth multiplier.
Okay.
See, Affirm has this massive, multi-year backlog of features and products they want to build. Previously, leadership constantly had to delay projects because they just simply lacked the engineering hands to do it.
Right, there's only so much time in the day.
Exactly. But now, the mandate is to build everything in the backlog. It's not about doing the same work with fewer people.
It's about doing 10 times the work with the exact same people.
Precisely. And there's also a non-negotiable reality of their specific industry. Affirm is fundamentally a credit and lending company.
Right. Highly regulated.
Incredibly regulated. In consumer finance, there is zero margin for algorithmic hallucinations. You cannot have an AI agent accidentally tweak an interest rate algorithm or introduce a subtle bug that discriminates against a specific demographic.
Because regulators do not care if the AI made a mistake.
They don't accept that as an excuse for violating lending laws, no. So you absolutely need humans to act as tastemakers and safety nets. The engineers provide the judgment, the architectural vision, and the strict accountability that the financial sector demands.
While the AI just provides the raw speed.
Exactly.
Okay, so with engineers churning out features at this unprecedented speed, all that new tech has to go somewhere.
Right.
It's not just sitting on a back-end server. It's being piped directly into the consumer's hands to change how you and I actually shop.
Yes. And the evolution of the Affirm app is the most visible result of this velocity. Historically, payment provider apps are purely utilitarian.
Right, like you open it, make sure a payment cleared, and you close it immediately.
Exactly. But Affirm is actively transitioning their app from a simple payment utility into a fully fledged shopping discovery engine.
They are meticulously optimizing specific sections, right? The notes specifically called out the first, third, and fifth tabs of the app.
Yes, to capture consumer attention and showcase tailored merchant promotions. They are basically replacing guesswork with surgical precision.
Which brings us to their Big Nothing Day.
Right. For their upcoming Big Nothing Day promotion, they openly admitted that in the past they would just sit around a lab brainstorming ideas for discounts. Just humans guessing.
Hoping something sticks.
Yeah. But now, Now they are feeding massive amounts of historical transaction data into machine learning models. They identify the exact SKUs, the specific merchants, and the precise consumers that will yield the highest conversion rates at the absolute lowest cost.
They mentioned they totally underestimated the early hours of their last event, but this time they are going to hit the ground running. So what does this all mean for the listener? Are we just going to be bombarded with more targeted ads inside a banking app?
Well, what's fascinating here is that Affirm isn't just trying to build a traditional advertising business. They are trying to construct a consumer flywheel.
Okay, break that down.
Think about a standard e-commerce journey. A consumer usually starts on Google or a massive marketplace like Amazon, right?
Right. You find an item and you only think about how to pay for it at the very last second during checkout.
Exactly. Affirm wants to invert that entire funnel. They want to train the user to train your brain to open the Affirm app first when you want to buy something.
Oh, wow.
Because if you start there, you already know your exact credit limit, and you know which merchants are currently offering guaranteed 0% interest deals.
So it becomes the ultimate top-of-funnel tool.
Yes, their active merchant base is growing fast. It's up 44%, including massive integrations with platforms like Shopify and Intuit. If a firm can deliver a consumer to a merchant's website who is already pre-approved and highly motivated by a personalized 0% offer, well, that consumer is infinitely more valuable than a random click from a generic banner ad.
They're dominating the digital checkout screen. But, I mean, e-commerce is still only a fraction of total retail. Most shopping still happens out in the physical world.
Right, at grocery stores, pharmacies, local shops.
Exactly. To capture that remaining 75 to 80% of commerce, they have to cross over from the digital screen into your actual physical pocket. Which brings us to the physical bridge, the Affirm card.
Yeah, the physical card is currently their fastest growing and most profitable product. They recently added 700,000 users, which pushes the active user base to 4.4 million.
That's massive growth.
It is. But the most staggering detail from their financial breakdown is their marketing budget for this card.
Right, let's talk about that.
They spend absolutely $0 on performance marketing or direct mailers for it.
Wait, zero. So no junk mail cluttering up my mailbox, no targeted social media ads begging me to sign up for a new card.
Nothing. The growth is entirely organic, driven just by re-engaging people who already use their digital app.
It's like they aren't trying to sell you a new car. They're just waiting until you already trust them as your mechanic, and then they're just handing you the keys.
That's a great way to put it.
But if they aren't doing marketing, how are they optimizing this so aggressively to get that kind of growth?
Well, the optimization required to achieve that kind of organic growth is just relentless. They employ intense, continuous multivariate testing.
Beyond just A/B testing.
Way beyond. They are running ABCDEF tests simultaneously. Every single pixel, every button color, every line of text in the app is analyzed to reduce friction.
Let's visualize what removing a pixel of friction actually looks like in a payment app for the listener. Because it sounds small, but it's not.
Oh, it's huge.
Like if an app requires someone to manually type their full address instead of auto-filling it, or if it takes 3 screen taps instead of 2 just to request a physical card, thousands of people will abandon the process.
Absolutely. So Affirm uses that AI-enhanced engineering team we talked about to smooth out every conceivable micro-hurdle. Requesting the card has to feel completely effortless.
And it extends to the physical usage of the card too, right?
Yes. This is where the meticulous, behind-the-scenes engineering really shines. Whenever an Affirm card gets declined at a register, a human actually reviews that transaction.
Really? A human?
Yes. They dissect it to see if it was a valid decline based on a bad credit decision, or maybe a user misunderstanding the app interface, or even a subtle engineering bug causing a timeout error at the point of sale. They are capturing all that non-e-commerce through sheer, relentless product optimization.
So it's like giving someone a VIP pass that they initially only use for, big, expensive concerts. But then, because the experience is so seamless, they realize that same pass also gets them free coffee at the cafe next door.
Exactly.
And discounts at the grocery store. Eventually, they just start flashing the pass everywhere they go.
And that right there is the concept of muscle memory. Initially, consumers use Affirm for deliberate, high-ticket purchases like furniture, electronics, vacation. But once that physical card is in their wallet, it transforms into a universal tool.
You start using it for everyday stuff.
Yeah, for fashion, for daily groceries. They stop thinking of Affirm as a specialized financing option and just start treating it as their primary purchasing mechanism.
Okay, so they have AI multiplying their engineering output, a digital app acting as a personalized shopping mall, and a physical card building daily habits.
Hmm.
If this ecosystem is so incredibly profitable, why aren't the massive legacy credit card companies or big tech giants simply copying the playbook and destroying them? Where is the moat?
Well, the legacy competitors are running into a very hard wall. They are finding out that underwriting is exceptionally difficult.
Right, handing out money is easy.
Exactly. Handing out money and accurately predicting that you will get paid back without relying on punitive consumer fees to cover your losses, that is a monumental mathematical challenge.
And this is where Affirm's 15 years of proprietary data gives them an edge. Because a traditional bank heavily relies on a FICO score, which is basically just a historical snapshot. It tells a bank what you did over the last 5 years.
Right. But Affirm's underwriting models evaluate the specific context of the transaction in real time. They look at item-level data. Are you buying a set of winter tires, which implies a necessity, or are you buying a luxury watch, which is discretionary?
Completely different risk profiles.
Completely. They use hundreds of behavioral data points to predict repayment on that exact item at that exact moment. Furthermore, a firm operates with a fundamental constraint that forces perfection.
They never charge late fees. Not a single one in their history.
Never.
Which is fascinating because late fees are essentially the lifeblood of traditional credit card profitability. If a traditional bank makes a bad loan, the compounding interest and late fees from other struggling consumers just help subsidize the loss.
Exactly. But without late fees to act as a buffer, a firm simply cannot afford to be wrong. Their underwriting models must be flawless. They completely refuse to compromise their standards just to sell packages to the capital markets.
And that discipline protects them when the macroeconomic environment gets murky. Now, this brings up an interesting contradiction, because their Pay in 4 segment is currently their fastest growing area. And the notes mention this growth exploded because they shifted their large merchant program to offer always-on 0% APR.
Right.
But here's where it gets really interesting. In the call, they openly stated that 0% APR loans actually yield a slightly lower margin for a firm. They call it RLTC, right?
Yes, revenue less transaction costs.
So if 0% APR loans make a firm less money on the margins, why on earth are they forcing it as an always-on feature for big merchants?
Well, if we connect this to the bigger picture, it makes perfect strategic sense. It is an educational tool for merchants. When a merchant offers guaranteed 0% financing, it drives massive predictable sales volume.
Right.
It doesn't just pull forward future sales, it actually converts hesitant browsers into buyers right in the moment. It removes the psychological friction of a large price tag.
Okay, so the merchant gets a huge bump in volume. But what does a firm get if their margin is lower?
They get the highest quality consumers. While the per transaction margin is slightly lower, the associated credit costs, meaning the losses from defaults, are drastically lower.
Oh, because the people who take 0% deals are usually financially responsible.
Exactly. The demographics that take advantage of those deals are predominantly highly responsible, top-tier credit users. So a firm acquires excellent customers, generates massive volume, and fosters deep loyalty from the merchants. A competitor who relies on late fees to subsidize their bad underwriting simply cannot afford to match that.
The credit losses would bankrupt them.
Absolutely.
Okay, so to bring this all together, what we are really looking at here is a masterfully connected system. A firm is using invisible AI agents to make their engineers 10 times faster. They are deploying that speed to turn their app into a shopping destination. They are using the physical card to build daily muscle memory in the real world. And underneath it all, they're leveraging 15 years of hard underwriting math to offer 0% loans that competitors physically cannot touch.
It really is a compounding advantage. While competitors try to pivot, a firm is just continuously optimizing an engine they've been tuning for over a decade.
It fundamentally changes how you look at the checkout screen. So, to you listening, the next time you are shopping online and you see that simple little Pay in 4 button, remember that you aren't just looking at a payment option. You are looking at the very tip of a massive AI-driven iceberg that is fundamentally redefining how risk and trust are calculated in real time.
And that leaves us with one final, really provocative thought to mull over.
Let's hear it.
Well, a firm is successfully training consumers to use their app as the starting point for shopping rather than Google or Amazon.
Right.
But if an AI knows your exact credit limit, your shopping habits, and the exact 0% APR deals available across thousands of merchants, how long until the AI just starts doing the shopping for you?
Wow. A personal shopper that comes with its own 0% financing.
Exactly.
That is definitely something to explore and mull over the next time you reach for your wallet. Thank you for joining us on this deep dive. Keep questioning the systems running quietly in the background of your daily lives because, well, that's where the future is actually being built. We'll catch you next time.